Hi there, this is Kritesh and welcome to TradeMan's YouTube channel. In this video, we are going to discuss what are index funds. First of all, if you are new to this channel, please subscribe. We publish new interesting investing videos every week. More than 5,000 companies are publicly listed in the Indian stock market. Therefore, selecting a few good stocks to invest can be a tiresome work for any fund manager. There are two popular approaches to managing a fund. First is actively managing, second passively managing. In an active fund, the fund managers choose the stock to invest based on the goal of that fund. Here the manager tries to beat the market by choosing better stocks. Nonetheless, the problem with active fund is that the returns on these funds depend on the goal and efficiency of the manager. Therefore, even if you are able to find a good fund with a coherent manager, still there is some danger of what might happen in the case the manager quits and moves to some other fund house. On the other hand, the passive funds are process driven. Here the fund invests in an index and the manager doesn't have to choose the stocks to invest. For a passive fund, even if the manager leaves, it won't create much trouble. Anyways, before we start discussing index funds in details, let's quickly brush up the basics. What is an index? Since there are thousands of companies listed on a stock exchange, hence it's really hard to track every single stock to evaluate the market performance at a time. Therefore, a smaller sample is taken which is the representative of the whole market. This small sample is called index and it helps in the measurement of the value of a section of the stock market. The index is computed from the prices of the selected stocks. For example, Sensex, also called BSE 30, is the market index consisting of the 30 well-established and financially sound companies listed on the Bombay Stock Exchange, BSE. Similarly, Nifty, also called Nifty 50, is the market index which consists of 50 well-established and financially sound companies listed on National Stock Exchange, NSE. A few other popular indexes in India are Nifty Next 50, BSE Small Cap, BSE Mid Cap, BSE S&P 500, etc. So what are index funds? Index funds are a passive investment strategy that attempts to generate a similar returns as a market index. These funds try to replicate the performance by entirely copying the stocks in the same composition as of the index. For example, if an index fund is benchmarked to Nifty 50, it will buy all the 50 stocks in the Nifty index in the same proportion as Nifty 50. Here is another example. Reliance Index Sensex Direct Growth Fund is benchmarked to Sensex. Hence, it copies all the 30 stocks of Sensex in the same proportion. Therefore, its return will be similar to Sensex. Here are a few other popular index funds in India. Now that you have understood the basics of index funds, let's discuss the pros and cons of index fund investing in India. We will start with the pros of index fund. One of the biggest advantages of investing in index fund is that they have a very low expense ratio. As these funds are passively managed, the expense ratio of index funds are relatively lower compared to active funds. The ratio can lie somewhere between 0.25 to 1.25. Second, no dependency on the fund manager. In the index fund, the stocks are not picked by the fund managers. These funds are merely copying the index. That's why even if the fund manager of any index fund quits, it won't create much trouble. Third, index funds are easy to understand and to pick. For the active funds, you will need to read and understand the reason why the fund manager believes a specific industry or a stock can perform well in future. And this can be a very tedious job. On the other hand, the stock selection in the index fund is quite straightforward. Now let's discuss few of the cons of index fund. First, there is no flexibility to the fund manager. In the index fund, the manager cannot pick stocks of their choice. So even if he or she knows some amazing companies, the fund cannot invest in them. Second, index funds cannot beat the returns from the market. The best an index fund can do is to match the returns of the specific index. Nevertheless, if you subtract the expense ratio and other charges, the returns are even lower. Third, index funds have to stick with poor stocks. And index funds cannot sell a stock which is a part of the index. For example, if a fund invests in Nifty 50 stocks, even if some of the stocks out of 50 are not performing well or does not have a good future potential, still the manager cannot sell that stock. An index fund has to keep all the stocks similar to the index in the same proportion. Fourth, an index fund holds all the risks associated with the asset class. If a particular index has some definite set of risks, then all the associated index fund will also have the same risks. Fifth and final point, there are some tracking errors in the index fund. Many times the index fund does not perfectly track the composition of the fund. This can be because of a number of reasons, like the difference in the time between accepting investments and buying stocks, rounding off the stock units, dividend adjusting, etc. In short, index fund investing in India has both pros and cons as discussed. So let's quickly summarize what we learned in this video. Index fund investing in India is a good alternative for the people who like straightforward way of investing in funds. These funds have no dependency on fund manager, a preset defined stocks, and a low expense ratio compared to the active funds. The best part, unlike active funds, index funds are easy to select. That's all for this video. I hope it was useful to you. If you liked it, please hit the thumbs up button and subscribe to this channel for more interesting investing videos. This is Kritesh signing off.